Metalheads. This is the No Bull Precious Metals Report, and I am Brad, your host as always, and we have quite a roaring day in store for you today. Diving right in, we can see on the FinViz dashboard that I've got up, the major markets are in the red. We can see the major indices, the Dow Jones, the S&P, the NASDAQ, the Russell. All of those are pretty well down. I mean, the Russell's down almost 0.7%. Everything else is, hovering, between that, really right around that negative zero point 0.5, negative zero point 0.3, negative zero point 0.4. So I mean, they're not off by that much, but they're definitely not showing gains today. We have a lot of red on the board. Natural gas is down, orange juice, coffee, lumber, sugar. Grains are kind of mixed. But the metals themselves, we can see that the only one that's actually doing anything positive is palladium today. Copper is down almost 4%. Platinum's down 1.3%. Gold is still kind of chugging along on the negative side, but still pretty close to the zero mark. Silver, however, took a dive. I've been watching it swing all morning long, up and down, and who knows where it's going to finally end up. But let's actually talk about the why for a moment. And part of this, we have to go into the reports. And as I had mentioned, today was a big day for those. We had retail sales excluding autos, producer price index, the Empire State Manufacturing Index, industrial production, capacity utilization, business inventories, and then of course coming up the NAHB Home Builders Index. So what we can see is that on the retail sales, we're down further than actually over double what the median forecast was at negative 1.3%. They were only predicting a negative 0.6%. When we take autos out of that, we can see that we're still down. They were expecting a 0.5 positive, and we're actually a negative 0.7. So that's pretty good distribution right there. The producer price index, we beat it by 0.3%. But the Empire State Manufacturing Index, this one, the previous was 24.3. The median forecast was 22.9. And then, of course, here we are at 17.4. So let's actually talk about this, because this isn't a report that a lot of people know about. It is a survey of manufacturers in New York that occurs on a monthly basis. Considering the important role that New York plays in the region, as well as Wall Street itself, it's a very well-watched index for trying to predict economic health. The thing to understand is that it has a lot of layers underneath it. It reflects significant portions of the larger economy and sets certain tones for the context of everything that goes on. For metals, specifically, and the reason that you're here, this is an important report because of the number of high-tech manufacturers that exist in the Empire State. So New York is far from being a dirty manufacturing state anymore. It's really kind of doubled down, along with the entire region. It's really doubled down on more clean, high-tech manufacture, some of the technology manufacturing, things like that. Lord knows why with the taxes that we pay up here, but, it is what it is. So as we start looking at that and digging in, the report actually indicates, and this is just the index number that I've shown, but there's an entire report that the New York Fed releases on this. And the report indicates that while manufacturing itself has been expanding, which is really just noted by the fact that the index is still a positive number, supply has softened. New orders have fallen by 12.6 points, while shipments fell by 15.5. Unfilled orders dropped 13.5 points, and inventories fell 9.7 into the negative territory. All of this while delivery times have lengthened. In short, it means that the flow of new orders has declined. So people aren't exactly ordering right now. Existing orders and backlog dropped though. All while existing inventory was exhausted to produce those orders, and all of that went out the door. So in context, what that means is that new orders being down isn't that great of a thing. You have to have a supply of new business coming in. But given that there's so much sand in the ointment of the supply chain these days, we can see that with the delays and the backups at the ports at Long Beach and others around the country. Exports and imports have been problematic, and getting all of that material in, there's a lot of overseas components that goes into finished products. So customers are waiting for old orders to be filled before they order any more. That's pretty much logical. And this is something that I've been watching for several months now, waiting for this bubble to kind of rise to the surface. Is that as we have all these orders that are kind of trying to force their way through the system, we're going to have this inventory lag. We're going to have exhausted inventories. We're going to start seeing kind of a weird supply chain that exists. And especially as we start getting further and further into the commodity range of things, we're going to start seeing some waves that are kind of crashing along with that. And that's where really silver and precious metals come in. So this isn't necessarily a bad or a permanent thing that supply is, perceived to be up while demand is perceived to be down. The one thing that we know about traders is that the professionals have a nasty habit of trading the news. They're going to look at these reports and they're going to react on it in almost a visceral fashion of, click sell or just not buying. So if everything remains constant and we don't get anything else into the cycle right now, I expect that traders are going to find something new and shiny that they're going to clamor on to once this report is kind of in the rearview mirror. It'll crop up though as we start seeing foundational resistance, especially as prices start to push higher, where by the end of the day they're going to have forgotten about this report. They're just going to realize that things have changed. Tomorrow there's going to be something new that's going to drive prices. But as we start seeing adjustments go up, because we know that just with the imbalance of commodities themselves, the reports are going to basically drive into that. And we're going to see these prices appreciate, whether it's for inflationary reasons or demand reasons or supply reasons or anything else that goes into basic economics. We're going to see these prices move. And as they start going upwards, this type of report is what's going to serve as foundational resistance. So traders are going to look at this, and they've already quantified a price that reflects what these numbers mean within the charts. So as those prices start to reach into those price levels, that's where traders are going to start to back off, because this is all factored into it. And we're going to start seeing those things start to align, and that's when we're going to start watching as more resistance forms. And if you've ever wanted to know the why of resistance, it has nothing to do with the lines on the chart. The lines on the chart are indicative of observations and where things tend to fall. But everything that the lines serve for us just quantify sentiment. They provide for us a way of basically being able to identify on the back end what the professionals and the analysts and multi billions of dollars of programming and analytics and artificial intelligence have already priced into the system. And it just gives us that availability of saying, wow, this is the threshold, this is where it's going. So as we start moving forward, this is really kind of the lay of the land for today. So what I'm going to do, let me jump into real quick what the market's doing. We can see that. We'll break into it quick. and then we'll go into a quick overview of retail because I don't want to do this as a 9-hour show today, but just give you an idea of where things stand. So the first thing up is the silver futures, and as we can see right now, as I'm putting this together, it's 27.73 is the current price, um, and throughout it we can see that we're still trading below that 5-day VWAP, probably around the -3 deviation band. That's really where the prices are hitting. As we start to apply like the previous day, where's that looking? Yeah, we're still well below. And then the intraday, that we're starting to come up on where the intraday is and where things are natural from that midnight point. So everything has been relatively consistent since midnight. It was just really that drop right after the 6 p.m. opening. We got to right around 2100, and then within the span of about half an hour, 45 minutes, that's when the price actually dropped. So we saw that significantly. That affected everything, and now we're just kind of sideways since then. We did touch that second day VWAP right here with the pricing, right first thing in the morning at 2:10 a.m. And move forward from there. So I expect kind of a similar chop today. Nothing that's too crazy. Gold. So gold is really reacting in a very similar fashion. We're at 1861.3. And one of the things that you might notice here is gold is, this is still that same bump that we saw in silver, but it's much more leveled. We saw that, as we're going through, here's that 2100 mark, if I can get there. So here's the 2100 mark. We see that, and then we just start going through. But as we start working through all of this, we can see that the gold price actually touched that -2 standard deviation mark. We see that it did that actually twice. It tested that boundary and it didn't like it, but it just carried on, did its thing, and kept going. So when we look at it from the previous VWAP, we can see that we're riding right below it, and we've touched it a couple times. So now if we look at the intraday, we're actually sitting much lower than that. So we're a little bit different than the way that silver is moving, but we're still in kind of a consistent market, still a lot of chop, and gold has generally been a little bit declining lately, which again isn't that bad for what we're trying to do, especially as we try looking at that gold silver ratio. So let's look at the retail. We can see that today, I'm just going to focus on these average prices right now. We can see the generic silver is down a little bit at $32.95. So if we start out from the weekend and we start looking at that, we can see the price has had some level of decline to it. I'll hit that median point, and we can see a pretty decent slope as it goes downward. It's gone from really was at the 33.53 down to 33.13. So a little bit of decline that reflects the choppiness of silver. With gold, let's see, kind of the same thing. Not to be too unexpected at all. We can see that this price, again, we drop this over here, and a little bit of a decline, but again, not significant. Gold really hasn't moved that much. So this was the report. This gives you a pretty good overview of what's going on in the world, why it's happening, and why prices are there. So when everyone's saying, JP Morgan is manipulating the price again and they're trying to keep silver down and, all that inevitably comes up whenever silver makes some sort of a decline, you can point them here and say, you know what? These are the reports. These are the foundations behind it. And that is why this is the No Bull Precious Metals Report. So I hope to catch you next time. If you like what I'm doing, like, share, and subscribe. And see you tomorrow.